Hi guys, it's Aesha Shah, your friend, lover, host, and a life coach. My today's audiobook is about account and bookkeeping. In bookkeeping, an account refers to assets, liabilities, income, expenses, and equity as represented by individual ledger pages to which changes in value are chronologically recorded with debit and credit entries. These entries, referred to as postings, become part of a book of final entry or ledger. Examples of common financial accounts are sales, accounts receivable, mortgages, loans, PP&E, payment payables and e-bills, common stock, sales, services, wages, and payroll. A chart of accounts provides a listing of all financial accounts used by particular business, organization, or government agency. The system of recording, verifying, and reporting such information is called accounting. Practitioners of accounting are called accountants. Classification of accounts. Based on nature, an account may be classified as real, personal, or as a nominal account. There are certain type of accounts: real accounts, personal accounts, nominal accounts. Real accounts represent physically tangible world and certain intangible things not having any physical existence. For example, tangibles are plant and machinery, furniture and fixtures, computers and information processors, cash accounts, etc. Intangibles are goodwill, patents, and copyrights. There is another type of account which is personal account, which represents business and legal entities and their bank accounts. Individuals, for example, individuals, partnership firms, corporate entities, non-profit organizations, any local or statutory bodies including governments as country, state or local levels. There is another type of account which is nominal. It represents temporary income and expense accounts for recognition of the implications of the financial transactions during each fiscal year until finalization of accounts at the end. For example, sales, purchases, electricity charges, etc. Example: a sales account is opened for recording the sales of goods or services, and at the end of the financial period, the total sales are transferred to the revenue statement account, which is called profit and loss account or income and expenditure account. Similarly, expenses during the financial period are recorded using the respective expense accounts, which are also transferred to the revenue statement account. The net positive or a negative balance, profit or a loss of the revenue statement account is transferred to reserves or a capital account as the case may be. Based on periodicity of a flow, the classification of accounts into real personal based on periodicity of a flow. The classification of accounts into real, personal, and nominal is based on their nature. For example, physical assets, liabilities, juristic entities, or financial transactions. The further classification of accounts is based on the periodicity of their inflows or outflows in the context of the fiscal year. Income is a short term inflow during the fiscal year. Expense is a short term outflow during the fiscal year. An asset is a long term inflow with implications extending beyond the financial period and, by the traditional view, could represent unclaimed income. Alternatively, an asset could be valued at the present value of its failure of its future inflows. Liability is a long-term outflow with implications extending beyond the financial period and, by the traditional view, could represent an amortized expense. Alternatively, a liability could be valued at the present value of a future outflow. Real account has the long-term inflow assets. Personal account has the long-term inflow assets as well as long-term outflows liabilities. Nominal account has the short-term inflows incomes and short-term outflows expenses. Items in accounts are classified into 5 broad groups, also known as the elements of the accounts: asset, liability, equity, revenue, expense. The classification of equity as a distinctive element for classification of accounts is disputable on account of the entity concept, since for the objective analysis of the financial results of any entity, the external liabilities of the entity should not be distinguished from any contribution by the shareholders. Okay, guys, this is something I like to talk about accountant bookkeeping. Think about it. I mean,